Good evening, everyone. I'm Melissa Brown, and this is your top story here on Pinoy Gazette. A newly signed law called the Capital Markets Efficiency Promotion Act, or CMEPA, is drawing attention and confusion among many Filipinos. Why? Because of a rule that puts a 20% tax on the interest income you earn from your savings in the bank. The law was signed by President Ferdinand Bongbong Marcos Jr. last May and took effect starting July 1, 2025. Its goal is to make taxes on financial income easier to understand and apply the same rule to all kinds of deposits. But some social media posts caused panic, saying that the government will now tax your entire bank savings. That is not true. The Department of Finance quickly explained that the 20% tax applies only to the interest you earn, not the full amount of your savings. For example, if you have P100,000 in your account and it earns P5,000 interest in a year, the 20% tax is only taken from that P5. No, not the whole P100,000. Finance Secretary Ralph Recto also clarified that this kind of tax isn't new. Since 1998, interest income from savings has been taxed at 20%, he said in a radio interview. In fact, most depositors were already paying this tax even before CMEPA. What's new under this law is that all interest income is now taxed at a flat 20% rate, even for long-term deposits that were previously tax-free if held for more than 5 years. According to tax expert Mon Abria, the change makes the tax system simpler and more aligned with international standards. He also said that deposits made before the law took effect will still enjoy the old tax rules until they mature. However, some groups believe the law is unfair. Sunny Africa, from the IBAN Foundation, called the flat 20% tax regressive. He said it affects ordinary savers more than the rich because both poor and rich people pay the same tax rate, even though their financial situations are very different. On the other hand, CMEPA also reduces taxes for investors. It lowers the stock transaction tax from 0.6% to 0.1% and removes certain taxes on investment schemes. This is meant to encourage more people and foreign investors to invest in the Philippine stock market. Michael Ricafert, chief economist at Rizal Commercial Banking Corporation, said these changes could make the Philippine financial market more attractive and boost investor confidence. But critics warn that regular Filipinos might not benefit from this, since many do not have extra money or knowledge to invest. Sunny Africa argued that instead of focusing on financial markets, the government should raise wages, improve social services, and fight poverty. One positive note: CMEPA does not affect savings in government programs like SSS and POG, including the popular MP2 savings program. These will remain tax-free, a move welcomed by many. The government expects CMEPA to raise around P9 billion in revenue between 2025 and 2028, with P500 million coming in this year alone. In summary, while the law aims to simplify taxes and grow the economy, it has raised serious questions. Will this law truly help the average Filipino? Or will it widen the gap between rich and poor? We will continue to follow the effects of CMEPA in the coming months. I'm Melissa Brown. Salamat po for watching Pinoy Gazette channel. Stay informed, stay safe, and good evening. Mabuhay.